Okay, let's have a look now where we make a sale, but the customer has the right to return. Remember, transaction price, we include what we expect to be entitled to, and therefore we can't include any anticipated return products. And remember, there can be no high probability that a significant reversal will happen. So what about this then? We sell goods and the customer has a right to return them in 90 days. But we've just started it, so we don't have any historic evidence either way. So therefore, we cannot be sure that there isn't a high probability of reversal. They might return them. And so therefore, we cannot recognise revenue. So what we can do then is we can debit cash. We can't credit revenue because there might be a reversal, or we can't be sure that there's no high probability of reversal, so we credit a refund liability instead. Now let's say 90 days have passed and there have been no returns. So now there can't be. Now we are sure. Now we know there is no high probability of a significant reversal. So what we do is we can recognise the revenue by getting rid of that refund liability that we created and then crediting revenue.